And we are back. Markets seemingly still of two minds about what they want to care about. The tech heavy parts of the stock market, be it NASDAQ or indeed even the S&P, tilted toward a late day rally. Meanwhile, the situation in indexes where tech is not such a big component, the Dow, the Russell, looking much soggier. And that's after we get a surge in treasury yields on the day back from the Memorial Day holiday for US markets. And seemingly, the sense that the Fed might even be on the fence about one cut this year. Looking at Fed funds futures now, barely a single reduction in rates being priced in. This, of course, leaving the markets kind of scratching their heads, and in particular, wondering what all this means for currencies, where the story has looked at least as confusing as stocks, but maybe a little bit more digestible. And that's exactly what we're going to look at here today. As we get these dramatic shifts in markets, we're going to try and figure out what all of this means outside of the perpetual hope that AI will turn everything into peaches and rainbows in the equities market. This, of course, is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And the focus today is going to be on the euro, and by extension, of course, the US dollar, because needless to say, currencies can only be valued as relative to each other. And the dollar and its response to what's been going on with the markets here ought to be a clear reflection of this back and forth in yields. And yet it seems not to be exactly, at least at first glance. And so perhaps if we want to understand what it is that the markets on the equity side are doing and why they seem to be as resilient as they are, perhaps looking at currencies and trying to understand, well, what is the market's relationship with the Fed outlook, and why does it seem, at least at first blush, to be somewhat counterintuitive, why all of these things are occurring, and then what are we to make of what's to come. So just to anchor ourselves in the conversation, here is the euro. This is the 6E futures contract, the euro's value against the dollar. And we can see here very clearly a trend lower for the euro that's been very kind of straightforward and stair-stepping in an orderly fashion since the beginning of the year. So here's the euro moving lower. It is setting lower highs. It's setting lower lows. And that's what the story seems to be until we get to about the middle of April, where we break convincingly higher, extend briefly upward, but then stop. And so on the one hand, we seem to have a convincing breakout and ostensibly a turning point for the dollar itself, because of course the euro is the greenback's most liquid counterpart. So when this changes course, it often implies that the dollar itself has rolled over this way or that. And so once you break this, it would appear, okay, well, maybe we are now going into a more constructive world for the euro, but then by extension into a broader US dollar sell-off. Except for when you actually get the break, it barely lasts 2 days and has since settled into a kind of choppy range roughly between the 108 and the 109 figure. So what is actually going on here? Well, we can see both the impetus for the euros move lower, as well as why it may have run aground middle of April and why it might not be making a whole lot of headway now. So consider here, in the green is the priced in Fed policy path for this year. You can see that it has corrected from a very dovish setting of about 150 basis points in cuts, which would, of course, imply 6 25 basis point reductions, a wild amount, needless to say, to now looking at basically one, but no more. If one reduction is 25 basis points and we're at 24, quibbling over a single basis point seems to miss the point. So let's call it we have one cut on the books. For the ECB, that is a much more dovish outlook at 64 basis points. So that's at least a pair of 25 basis point cuts. And then if we were to look at here the remainder, then there's about 11 basis points in the direction of a third here. And doing the likelihood math here, that amounts to about a 44% chance that we get a third cut beyond 50. So, needless to say, this ought to be something that has a clear yield advantage for the dollar. And so it would seem that since the beginning of the year, as these changes have occurred, then you ought to see the euro decline, and indeed it has. There it is. There's the turn of the year. Euro has been heading lower. There's the turn of the year. There's the adjustment in Fed policy odds. Now, obviously, these are both adjusting higher. And it's important to consider that this is a reflection of the kind of gravitational pull of the dollar. It is, after all, overwhelmingly the currency of commerce globally, according to the Bank of International Settlements. Close to 88% of global monetary transactions are settled in dollars. So when there is a change in borrowing costs expectations for dollars, that echoes market wide, because it essentially becomes a change in borrowing cost expectations everywhere and in any currency, because most commerce is still ultimately done in dollars. So both of these things have adjusted, but the dollar has maintained its advantage. So how is it then that the euro managed from the middle of April to push higher, but also why is it now getting stuck? Well, if we look at the spreads, in the dark blue here is the spread for this year, the expected rate year-end 2024 for the Fed, less the expected rate for the ECB. And we can see that the Fed's advantage is pinned at about 40 basis points right here. We can also see that if we look out to 2025, there has been a significant shift where in 2024, the pricing has been fairly steady. So here's mid-April. Here's where the euro, in the light blue here, is the euro against the dollar. There's the exchange rate. Here's the rebound. Here's the beginning of the year. So since the beginning of the year, we can see this spread moving in the dollar's favor for both this year and next. And the euro is moving down as that is occurring. So here we have the dollar having, at the start of the year, even a slight disadvantage against the euro, moving up to about a 40 basis point advantage and stalling here, We haven't gone anywhere in 6 weeks on the outlook for this year. Keep in mind, since then, we have had a Fed policy announcement, we've had all kinds of inflation data, but the markets seem to have anchored these expectations. This is different, clearly, from what is happening with the expectations for next year, where we've gone from close to 70 basis points of a dollar advantage to closer to 30. And it seems like this has been the object of speculation. So the market has essentially focused on next year's outlook in saying, well, here is a shift in favor of the euro because next year's dollar lead has shrunk by nearly 40 basis points. And that perhaps explains this bounce. It certainly seems to happen at exactly the same time. And indeed, if you look at the expected 2025 policy path, and this is actually mislabeled here, the purple here is supposed to be the dollar. Apologies for that. The blue is supposed to be the ECB. What you find here is that for the ECB, there's been virtually no change. We've dipped a little, but we're basically sitting at an outlook calling for 50 basis points in ECB rate cuts for next year. But when you look at the outlook for the Fed, the situation is obviously much more adjusted. So you went from at the top of that purple line there, 40 basis points in cuts for next year to now 63. And to make sure that this is not altogether confusing, we'll go ahead and actually fix this image for you. There it is. We don't want to lose anything in translation here. That's actually the correct labeling of this chart. And so, apologies about that again. So what you see here is that the outlook for the euro hasn't really moved, but the outlook for the dollar for next year seems to be seeing a lot more of a pushing of rate cuts from this year into next. And this perhaps explains how these spreads have moved in the way that they have and why the adjustment in next year's outlook has given us this euro bounce. Why are we looking at an ECB rate that's been basically steady and a dollar one that's more dovish? Well, you can see it in the economic data. Here, very tellingly, is mid-April. And you can see this is where U.S. economic data, after holding steady for much of, let's call it mid-February through early to mid-April, this is where it starts to take a very concerted move lower. U.S. economic data outcomes start to underperform by an increasing margin relative to consensus forecasts. Not so in the euro area where they're holding steady. So while the data is giving us no change in the outlook for the ECB for next year, it certainly seems like there is a change in U.S. data flow and therefore a more dovish tilt to next year's expectations on the U.S. side. Hence the euro bounce. Okay, so where does this take us from here? Well, the next big inflection point for this comes from the euro area via Eurozone inflation numbers. They're expected to give us a slight uptick from 2.4 to 2.5%. But as we can see here, the overall makeup of what this inflation looks like now has significantly evened out. So there was obviously a big hump here in food costs last year. There's a big hump in energy costs the year before. Now it seems like the situation has evened out significantly. And so the ingredients for the ECB to move forward with cuts are apparently there. If we look at these components, we can see food has significantly eased as a catalyst. Energy is not on the radar very much at this point. Instead, most of what's left is in this discretionary category here. And that, one would think, ought to be responding to relatively weak economic conditions in the region. We can see here from the latest PMI data, as a matter of fact, we are seemingly clawing our way back a little bit on Eurozone economic activity. We're back over this 50 level that separates growth from contraction on the composite PMI level. And that's as we've had a little bit of a pop in the service sector since the beginning of the year. But even with that there, this very same PMI report says that actually the pricing power situation remains weak, even as economic activity finds a bit more of a tailwind. And of course, recovering from 9 months of contraction here, the late 2023 recession in the Eurozone, that'll take quite a bit more months of positive growth to come back. So as we look at this, then, there is perhaps scope for this to miss on the downside and to suggest that no, actually, the situation in the US, especially after last week's very buoyant service sector data, that perhaps the situation in the US is not so dire for next year on the rates front relative to the euro area. And so perhaps the shifting in these spreads, we can see here, has been a bit overextended. And so as we've now anchored on both of these, perhaps the euro is out of steam and looking to reverse lower. So if this data surprises on the downside, a good start would be to round this top and break back here under the 108 figure. And so we can see if that gives way, then we will have frost into much more significant unwinding of whatever this breakout is, and perhaps re-engaged with what is an extended euro down move that has resumed its overall direction. And that is macro money for today. Thanks very much, as ever, for joining. We are here for the rest of the week through Thursday. We'll be back to our normal scheduling next week when we are not off for the holiday, Monday through Thursday. Of course, join us for overtime before macro money each day. Good luck trading. See you tomorrow.